Well, at least the budget is over. Months of speculation, leaks and U-turns has made it one of the most feverish of budgets. And this budget fever even slowed down the economy, with consumers holding back to see what taxes would go up. In the end, you could say the budget basically boils down to more government spending, more tax and more borrowing. Taxes will now rise to 38.2% of GDP, the highest level since the Second World War. The government will be spending 44% of GDP, which makes it one of the highest in the world. The biggest area is welfare spending, which will rise from 314 billion this year to 406 billion in 2030-31. Of this, the biggest rise is from the state pension, which will go up from 138 billion to 180 billion. Yet, the thing it didn't mention was that this is just the start. How are we going to fund future pension spending when it rises to 8% of GDP? This is on top of healthcare spending rising as a share of GDP. Defence spending is supposed to jump from 2.5% to 5% of GDP by 2035. It's going to be a pretty big state in the future. Whilst things like the triple lock pension guarantee is ironclad, there were tax rises for the younger generation on pensions, savings and income tax thresholds. Now, there was no increase in the basic rate of income tax, but there was a 3-year freeze in personal tax allowances, which ironically raises a very similar amount, and it does beg the question, when is a tax rise not a tax rise? Ironically, it means that inflation actually became the Treasury's friend and helped OBR forecasts to be better than expected because a high inflation led to more tax revenue. But high inflation will push more people into higher tax bands. And if we look at the proposed budget changes, one thing that is quite striking is how borrowing will increase for the first 3 years, but then in the final year there will be a substantial rise in tax, unspecified spending cuts, and it all leaves a quite dramatic reversal by 29 to 30. Essentially, the good news, if we call it good news, is front-loaded. The bad news is kind of deferred for 4 or 5 years' time. Now, that's nothing new. It's been a trick of chancellors for many years now. Interestingly, the bond market reaction was surprisingly sanguine about this sleight of hand. But after years of missing borrowing targets, does anyone really think that 2029 will be the year of massive fiscal improvements? However, despite growth of 1.5%, growth is now forecast to be lower in future years. But hidden away from view is the more important story that the OBR forecast an improvement in real household disposable income of just 0.2%. And if you take into account housing costs, the impact will be a negative for many people. Housing, I guess, is one of those areas where the budget couldn't really address, but it is the hidden penalty for many people in the UK. Now, weak reforms to planning rules and building houses will increase supply a little bit, but it is far too limited to make any kind of substantial difference. And the bigger picture is that housing unaffordability shows no sign of improvement. Also, there were very few measures in the budget for promoting economic growth, such as simplifying the tax code, promoting investment, or efforts to reduce inactivity. Now, the budget speech did mention that one new reform would get 15,000 people off benefits and back into work. Now, that might well be welcome, but to put it into context, since 2019, disability benefit claimants in England and Wales have increased by 1.2 million, 40% jump. And that explains some of the increase in health-related benefits, which is another source of rising government spending. In sum, the OBR forecasts that changes to government policy in this parliament will raise GDP by 0.2% by 2030. But bear in mind, even that small rise in GDP is not necessarily translated into higher per capita living standards. But bear in mind, even a rise in GDP does not necessarily translate into higher per capita living standards. And you can see the bigger picture of the UK economy. GDP gone up a bit, but GDP per capita are pretty stagnant. And the very disappointing growth in real incomes is the overriding backdrop to the budget. And also, it does raise the bigger question of how much can you rely on OBR forecasts? Are their growth forecasts still optimistic? They're still more optimistic than most independent forecasters. Because yet again, there was another downgrade to productivity growth, which makes it a very frequent pattern in recent years. And with the UK economy underachieving, there's still a risk of further deterioration in finances and a return to that cycle of a chancellor having to come back saying, please, can I have some more taxes? Now, as has become quite typical of UK budgets, there's no particular long-term strategy on tax, more of a kind of short-term fudge. Now, for those keen to tax wealth, the new 2 million tax on mansions and extension of council tax bans is a step in the right direction. But it is worth pointing out the sums raised are relatively small, just £400 million from a mansion tax by 2028, and the council tax will still remain highly regressive. But it does give an indication of why wealth taxes are not a magic bullet. And by contrast, taxing pension contributions will raise significantly more, and this will boost Treasury coffers by around 4.6 billion. But don't be surprised if it does lead to less people saving in the long term. Not great when the UK faces this demographic change and many more old people in the future. Now, on a more positive note, there was an effort to try to address the cost of living pressures. A freeze in rail fares, petrol tax, removal of energy company obligations, which increases electricity bills. And after last year's tax rises contributed to inflation, these changes will at least give a temporary improvement in the headline inflation rate next year. You can see it reduces inflation by 0.4%, at least for 1 year. Now, normally I'd dismiss this as just a gimmick, but I think in context for UK's unrelenting bad news on inflation, at least will help in the very short term, possibly make interest rate cuts more likely next year, and it probably explains the bond market's relatively positive reaction. They expect lower rates as a result. But of course, whilst it may buy some short-term benefit on inflation, it is very much that, just short-term. It doesn't address the underlying reasons for the UK's tendency towards higher inflation than other countries. It also means that petrol tax has been frozen for now 15 years, and you can see how the OBR expect fuel tax revenues to fall, and this will only be marginally offset by the proposed rise in taxing electric vehicles. And it's all very well reducing petrol tax, but it has to be put against a context of rising spending as a share of GDP. How are we going to fund it? In fact, introducing EV tax is one of the few long-term strategic thinking, because there's far too much short-termism. Even abolishing the energy company obligation will reduce grants for improving insulation of homes, something that helps in the long term to reduce energy bills. Something, by the way, the UK is not very good at, one of the worst insulated homes in Europe. Now, a positive outcome, you could say, is an increase in fiscal headroom from 9 billion closer to 21.7 billion. And the Chancellor will hope that this will avoid the deeply damaging speculation about what taxes will have to rise, which undoubtedly damaged the economy this year. Yet, despite significant increase in tax, all it needs is some external shock or disappointing growth for speculation to return. 21 billion can easily be wiped out by a black swan event. Now, another thing hidden away in the OBR report were very brief mentions of hidden spending pressures. Questions about healthcare spending, social care and special needs education. For example, if SEND is fully funded through the education budget, it would actually imply cuts of 1.7% per child instead of an increase of 2.4% as the government's claim. Also, there was an assumption that other departments will see actual cuts towards the end of a parliament. And this is departments like justice, which are already struggling under the weight from several years of cuts. So the UK faces the unwelcome reality that although we head towards ever higher levels of government spending, it's not clear that people will see any material improvement and satisfaction with public services. Waiting lists have marginally fallen but still remain elevated, and there's really mostly money for firefighting short-term problems and fairly limited public sector investment. Now, the end to the two-child cap is definitely welcomed by child poverty campaigners. Without a reversal to the policy, child poverty was expected to rise in the coming years, which does of course have long-term economic costs, and this will halt that rise. In fact, the UK budget is highly progressive. Everyone pays more tax, but welfare spending and benefits in kind from public service increases, especially for low-income households. But the problem is that whilst it is easy to keep adding spending commitments, it's very difficult to then take them away. And so the underlying issue is that spending will have to increase a lot, and that the tax rises we see today are not the end of the story. Now, what about the other bigger things that the budget failed to mention? The OBR reiterated its belief Brexit would damage productivity growth by 4%. It means a loss of £90 billion in tax revenues. UK exports have really suffered in recent years. It's not just Brexit, but also high energy costs, expensive planning rules, lack of confidence to invest, but of course a decline in industrial production. And the concern is that the rising share of government spending could well crowd out some of the more productive industries where you see higher rates of growth and productivity from. Now, the fundamental problem of this budget, and in fact budgets of previous years, is that they always seem designed to deal with short-term political pressures with very little willingness to take risk, fundamentally start again. Now, you could say the problem was the original sin was all the manifesto commitments, which effectively tied the government's hands behind their backs, and it led to this missed opportunity, and a chance for a fresh start is largely squandered. So it's really back to the old British way of muddling through, hoping something turns up. Now, to be fair, it was a difficult hand, but when you basically keep the same policies, but just a bit more spending and tax, it's hard to dramatically change the script. At least for the short term, the economy will muddle through. Perhaps we will get lucky, a new era of productivity gains, and that is possible, although it could go the other way too. And the UK economy does have some strengths, but whether this budget does enough to unlock them is very dubious. Anyway, do let me know what you think in the comments. Was it a good budget for you? Were you disappointed? Or was it very low expectations, what you kind of expected? Anyway, thanks for watching. Do subscribe and see you soon.